Imagine you wake up tomorrow morning, grab your phone, open your brokerage app, and your silver position is down 40% overnight. Thousands of dollars gone while you were sleeping. Panic everywhere. Social media is screaming manipulation and buy the dip. But your account is bleeding, your margin level is flashing red, and you realize something terrifying. You didn't just lose money, you walked straight into a $52,000 trap that was set long before this crash ever happened, and no one warned you. In this video, we're going to talk about that trap. Not just silver might go down, because that's obvious. We're going to break down how a silver crash could actually be used to transfer wealth away from regular investors, why the number $52,000 is so important in the psychology of this market, and how smart money is quietly positioning itself while retail investors are getting hyped up into a corner. If you care about your money, this is something you need to understand before it's too late. Before we dive in deep, quick thing, if you're serious about protecting and growing your money, hit that like button and subscribe to Finance Currency right now. It takes you 1 second, it's free, and it tells the algorithm to push this kind of content to more people instead of just pushing hype and clickbait. And remember, nothing in this video is financial advice. I'm not your financial advisor, I'm just a guy talking about money on the internet. Use this as education, then do your own research and talk to a licensed professional before making big decisions. Let's start with a story, because this is how the $52,000 trap usually looks in real life. We'll call him Mike. Mike is 34 years old, lives in the US, has a regular job, and like a lot of people, he's been watching the economy and doesn't like what he sees. Inflation, crazy government debt, money printing, the dollar getting weaker over time. He goes on YouTube and TikTok and he sees video after video saying silver is going to $100, $300, even $1,000 an ounce. He hears silver is the most undervalued asset on the planet. The banks are suppressing it. When it finally breaks free, regular people who bought early will be rich. It feels like a once-in-a-lifetime opportunity. Then he sees one number again and again, $52,000. Maybe it's in an ad from a precious metals dealer. Maybe it's in some financial freedom blueprint PDF. Maybe it's from an influencer saying, if you just stack 1,000 ounces of silver, when it hits 50 TAs, you'll have $52,000. That's a new truck. That's a down payment on a house. That's your ticket out of the 9 to 5. It sounds simple. It sounds achievable. That $52,000 number sticks in his brain. It's not $1 million. It's not some insane lotto jackpot. It feels real. It feels close. So Mike starts buying. At first, he buys a couple of coins. Then he finds dealers who say, don't buy those boring low premium bars. Buy these special collector coins. They have more upside. The premiums are high, but he doesn't care because he's thinking about that $52,000 number. Then he opens a brokerage account and buys a silver ETF. Then someone tells him, if you really want life-changing gains, use leverage. Futures, options, margin. That's how you turn 10K into 52K when silver explodes. And that's where the trap quietly closes around him. The $52,000 trap isn't about one exact product or one exact dealer. It's a mindset. It's the combination of a believable dream, a real asset like silver, and a hidden risk structure around it that almost guarantees most small investors will get wrecked during the next big move, especially if that move starts with a crash. And I want you to really listen to this. The danger is not that silver is a bad asset. Silver can be a great hedge. The danger is the way regular people are being pushed into silver and the setups that are perfectly designed to blow up their accounts in a violent downturn. To understand why a silver crash is so dangerous, you have to understand what silver actually is in this modern market. Silver wears two hats. On one side, it's an industrial metal. It's used in solar panels, electronics, medical devices, EVs, 5G, and a ton of tech that runs our daily life. Companies buy it, manufacturers need it, demand goes up and down with the economy. On the other side, silver is a monetary metal. It's a cousin to gold. For thousands of years, people have used it as money and as a store of value when governments screw up. When people lose faith in currencies, they run to gold and silver as a kind of panic insurance. Those two roles create massive volatility. When the economy looks strong, industrial demand can push silver up. When the economy looks weak but inflation is rising, fear can push silver up as a store of value. But when there's deflation or liquidity crises or big players need cash fast, silver can crash harder than almost anything because it's seen as a sellable asset. You can't dump a building overnight, but you can dump silver futures in a split second. That's why we see moves where silver drops 10%, 15%, even 20% in a very short time. And that kind of move is exactly what blows up leveraged positions. Now think about that $52,000 dream again. The stack 1,000 ounces and wait for $52 idea doesn't sound crazy. Historically, silver has gone over $40, even hit near $50 in 1980 and again around 2011. So when someone says $52 per ounce, people think that's not impossible. It's just a little bit higher than last time. The trap is that they don't show you what happens in the journey from here to there. They show you the top of the mountain, not the cliffs you have to climb. Here's how a typical trap plays out. A lot of people start buying silver as the price is already rising. They hear the bullish narratives, they see charts going up, they feel FOMO. Dealers raise premiums, hype builds, social media goes crazy. Then the leverage comes in. Futures traders, margin traders, options traders, they all pile in. Banks and big funds know this. They can see positioning. They can see where the weak hands are, where the stop losses probably sit. The whole market becomes like a tower built on leverage. Then something triggers fear. It could be a surprise interest rate hike. It could be a liquidity crunch somewhere else. It could be a big fund that needs to raise cash. It doesn't even have to be directly about silver. The big money starts selling futures contracts. Algorithms kick in. Liquidity thins out. Price gaps lower. Margin calls hit accounts. Retail traders who used leverage are forced to sell at the worst possible moment. Some of them don't even choose to sell. The broker sells for them when their margin requirement is breached. In 2 days, silver can drop 20%. Physical stackers are shocked, but they can hold. The guys with leveraged futures and options, many of them are wiped out. And this is where the $52,000 trap reveals itself. The dream of turning 10K into 52K was built on the idea you could hold through the volatility, but the structure you used, margin, leverage, overpaying for premiums, actually guaranteed that you would be one of the first people thrown out of the game when things got rough. On finance currency, I don't want to just scare you and leave you there. I want to break this down so you can see the moving parts and decide how you want to approach this for yourself. So let's slow down and look at the mechanics. First, how is the price of silver even set? Most people imagine a bunch of people trading physical bars back and forth. That's not how it works. The price you see on your app is mostly driven by paper markets, futures contracts, options, and large funds that trade silver exposure without touching a single physical ounce. On exchanges, traders can control large quantities of silver with a relatively small amount of money down. That's leverage. It makes moves bigger in both directions. Now, if a market is heavily long, meaning lots of traders are betting on price going up, and price starts to wobble, you get a chain reaction. One trader sells, price ticks down. That triggers another trader's stop loss. Their sell order hits the market and pushes price down further. That triggers margin calls and more forced selling. The math is brutal. A 10% move in the underlying asset can mean a 50%, 80%, or 100% loss for a leveraged position. This is how long-term bullish investors can get knocked out during a short-term crash. Second, there's the premium trap. This is sneaky but powerful. A lot of people in the US are buying silver not on low premium bars or close to spot coins, but on high premium collectible coins, often marketed through aggressive phone sales or online ads. They might be paying 30%, 40%, sometimes 50% above the spot price for those products. So if spot silver is at $25, they might be paying $35 or more per ounce. Now imagine a crash. Spot drops from $25 to $18. That's a 28% drop. But in the panic, dealers also cut the buyback price and shrink premiums. That person might be down 40, 50% on their position, even if they thought they were just buying physical and holding for the long term. That premium difference is part of the $52,000 trap too, because in their mind they calculated 1,000 ounces x $52 equals $52,000. But in reality, they didn't start at $25, they started at $35. They have to climb that premium mountain first. Third, there's the all-in mindset. People scared of inflation or a dollar crisis sometimes go all in on silver. They sell stocks, keep no cash, and put everything into gold and silver. Emotionally, it feels safe. But financially, it can be dangerous if they have no liquidity when a crash comes. Because in a real crash, sometimes everything gets sold, even the assets you thought were safe. If you need cash for bills, emergencies, or opportunities, and you're forced to sell silver into a crash, you become part of the liquidity for the people buying at the bottom. That's how your $52,000 dream becomes someone else's $52,000 profit. So what does a silver crash warning actually mean for someone watching this right now? It doesn't mean never touch silver. It means understand the game you're playing, and don't let marketing narratives push you into setups that you don't fully understand. You can respect silver's potential while also respecting its ability to punch you in the face if you're overexposed or overleveraged. Think back to 2011. Silver ran up close to $50 an ounce. People were euphoric. To the moon, energy everywhere. Then the music stopped. Within a year, silver was under $30 again. Within a few years, it was under $20. The people who chased late, who bought the top with leverage, and who thought it could only go higher were destroyed. Many of them never came back. That's what big money counts on. Retail gets excited at the top, gets destroyed in the crash, and then big money accumulates quietly at lower prices. Now, I want you to imagine a future scenario. I'm not saying this will happen exactly like this, but walk through it with me. Imagine silver starts a strong move up. The dollar is weak, inflation is sticky, the Fed is trapped, geopolitical risk is rising. Silver pushes from the low 20s to $30, then $35. Social media starts buzzing. You start seeing Silver Squeeze 2.0 posts, hashtags trend, Google searches explode, dealers have delays, physical premiums spike, stories of shortages circulate. Everyone says, this is it, this is the big one. If you miss this, you'll regret it forever. Our hypothetical guy, Mike, has maybe $15,000 saved. He's been hesitating, but now the fear of missing out is stronger than the fear of losing. He buys some physical silver with high premiums, then he opens a margin account. He uses leverage to buy a silver ETF and maybe even a couple of call options. On paper, it looks brilliant. As silver moves from $35 to $38, his leveraged positions show big percentage gains. He watches his account value rise and thinks, if I can just get this to $52,000, I'll cash out. But remember, the market doesn't care about his target. The market cares about liquidity. At some point, big players who bought earlier decide the risk-reward is not as good anymore. Maybe economic data comes in weaker than expected. Maybe there's dollar strength. Maybe some hedge funds are in trouble elsewhere and need cash. Selling pressure builds, price stalls. Then suddenly, a day comes where silver drops 5%. That's not the end of the world, but it scares some people. They sell. The next day, another 7% down. Margin calls. Forced sales. Algorithms chasing the move. Liquidity disappears, spreads widen, and in one brutal week, silver is down 20-25%. The physical stack you own is down on paper, but it's still there. The I'll hold for 10 years part of you is okay. But the leverage trades, the options that expired worthless, the margin positions that were liquidated at the worst moment, that's where your $52,000 dream turned into a $0 reality. And if on top of that you started with high premiums, your break-even price was way higher than you thought. That's the trap. So what can you do to avoid being the exit liquidity in a silver crash? Again, this is not financial advice, but there are some principles you can think about. First, understand your time horizon. Are you buying silver as a 10-year hedge or as a 10-day trade? Those are two completely different games, and mixing them without a plan is how people blow up. If you're a long-term holder, you need to mentally accept big drawdowns without panic. If you're a trader, you need strict risk management and stop losses. Second, respect leverage. Leverage is a tool, not a lifestyle. It makes small moves feel huge. If you're new, think very hard before using margin or futures in something as volatile as silver. There's a reason pros can get wiped out in this market. And if the pros can get smoked, ask yourself what chance you have if you're winging it on a hunch. Third, be very aware of premiums and products. If your goal is ounces, focus on low premium, widely recognized products. Understand how much above spot you're paying and what realistic buyback prices are. Run the math. If you buy at $35 when spot is $25, ask yourself how much spot has to rise just to get you break even. Don't let a shiny coin and a smooth sales pitch become part of your own $52,000 trap. Fourth, keep some dry powder. Crashes are awful if you're forced to sell. They're powerful if you're able to buy. Having some cash or liquid reserves means you don't have to be the one dumping at the bottom. Instead, you can be the one quietly accumulating while everyone else panics. On finance currency, I want you to start thinking not just will silver go up or down, but how is the game structured so that regular people usually lose? Because once you see the structure, you stop playing the game on easy mode for the other side. You stop chasing targets like $52,000 just because they sound good, and you start building a plan that survives both booms and crashes. There's another side to this too that people don't talk about. A silver crash can actually be used as a psychological weapon. Imagine spending months hearing silver to the moon, then living through a 40% crash. A lot of people will swear off silver forever. They'll sell at a big loss, vow never to touch it again, and quietly walk away. That's usually when value starts to appear. That's when patient capital steps in. So when you hear silver crash warning, don't just think doom, think test. It's a test of your conviction, your risk management, and whether you actually knew why you bought silver in the first place. Ask yourself some blunt questions. If silver dropped 30% from here in a short time, what would you do? Would you be forced to sell? Would you be okay holding? Would you be excited to buy more? If your honest answer is, I don't know, I'd probably panic. Then your position might be too big or too complex for your comfort level. Pain comes when your position size is bigger than your emotional tolerance. The market will find that weakness and exploit it. Also, be careful about building your entire worldview on one narrative. There are silver bulls who say, this is the most suppressed asset in history. When it breaks free, it'll go straight to $200. There are silver bears who say, it's just an industrial metal, it'll never see $50 again. The truth is, no one knows the exact path. What we do know is that silver is volatile, it's tied into global liquidity, and it can move faster than most people expect. Building a rigid belief system around a single target like $52,000 can blind you to signs that risk is rising. The smarter way is to think in scenarios. If silver goes up hard, what will I do? If it goes sideways for years, what will I do? If it crashes, what's my plan? Am I going to average in slowly? Am I going to keep position sizes sane? Am I going to avoid leverage unless I truly understand it? This kind of thinking is not sexy, but it's how you avoid being another story of, I almost made it to $52,000 and then lost everything. Another piece you need to be aware of is the role of sentiment and social media. In our time, markets don't just move on fundamentals, they move on narratives. When you see everyone suddenly talking about silver, when celebrities start mentioning it, when you see silver millionaire by 2027 videos popping up, that's a signal. Not necessarily to run away, but to be extra cautious, because by the time a story reaches that level, a lot of easy upside may already be priced in, and risk can be much higher than it appears. Big money understands crowd psychology. They know that if they can get enough retail investors believing in a simple story, like buy 1,000 ounces and wait for 52,000, they'll have a liquid market to exit into when they want to sell. It doesn't have to be a cartoon villain conspiracy. It's just how markets work. Liquidity has to come from somewhere, and often it comes from regular people who showed up late to the party. So when you watch videos like this on finance currency, don't just listen to what I'm saying. Notice how you feel. Do you feel fear of missing out, fear of loss, anger at manipulators, hope for quick gains? Those emotions are the levers that get pulled in this game. The stronger the emotion, the more careful you need to be, because strong emotion often leads to weak decisions. Let's bring it back to you. If your goal is to protect your wealth over the next 10, 20, 30 years, silver might have a role in that. It's been money for thousands of years. It has real industrial use. It's not some made-up token. But you don't need to become a fanatic about it. You don't need to sell your soul to the $52,000 dream. You don't need to put yourself in a position where one bad week in the market wipes out years of saving. Instead, you can decide on a sane allocation that fits your overall life. You can diversify, you can stay away from products that clearly overcharge you, you can treat silver as part of a bigger strategy, not as a lottery ticket, and most importantly, you can prepare mentally for the crash before it comes, so that if and when it does, you're one of the few people thinking clearly instead of panicking. As we start to wrap this up, I want to hear from you. Tell me in the comments, do you think silver will see $12 or $100 first from here? And more importantly, what's your actual plan if either of those levels happens? Don't just say I'll buy or I'll sell. Share your thought process. When you write it out, you'll often see gaps in your own thinking, and reading other people's comments can give you ideas you hadn't considered. Also, if you know someone who's been talking a lot about going all in on silver, or who's hyped up on those turn 10K into $52,000 with this secret silver strategy type videos, share this video with them. You might save them from learning these lessons the hard way. A 2-second share from you could literally help someone avoid blowing up their savings. If you found value in this breakdown, make sure you're subscribed to Finance Currency with notifications on, because we're going to keep digging into the traps and setups that most people never talk about. Hit like if you made it this far, drop your thoughts below, and let me know what other topics you want deep dives on. Gold, the dollar, real estate, whatever's on your mind. Remember, the goal is not to predict every tick of the silver price. The goal is to build a mindset and a strategy that don't break when the next crash comes. Don't be the person staring at a red screen thinking, I was supposed to have $52,000 by now. Be the person who understands the game well enough to stay in it, survive the storms, and come out stronger on the other side. You've been watching Finance Currency. Thanks for staying with me all the way to the end. Stay smart, stay skeptical, and I'll see you in the next one.